There's a window in business life somewhere between $250,000 and $1 million in revenue, where the decisions you make have an outsized impact on what comes next. You're growing, things are moving fast, you don't have time to stop and do a full financial review. And honestly, the stakes feel lower than they will at 5 million or 10 million. But the habits you build, the structures you set, the advisors you hire, all of that compounds. And the mistakes you make in this window compound too. In this video, I'm going to walk you through 5 moves that every growing business should have in place before they cross $1 million in revenue. Nothing exotic, just the foundations that most people skip. I'm Matt Losanno with Cinder Wealth. Quick disclaimer. This video is educational only. It's not personalized tax, legal, or financial advice. Every business is different. Always consult your own advisors. All right, move number 1. Stop defaulting to whatever retirement plan your CPA set up years ago and make sure you're using the right one. For solo operators and spouse-only businesses, that's almost always the individual 401k. Higher contribution limits than a SEP or a simple, a Roth option, and the ability to borrow against your balance if you ever need liquidity. In 2026, you could defer $72,000 per year combining employee and employer contributions. At a 30% combined tax rate, that's over $21,000 in annual tax savings. For businesses with employees, a 401k with a profit sharing, designed correctly, can still heavily favor the owner while providing a benefit to your team. Here's the urgency. You have to establish the plan by December 31st to get the tax deductions for this tax year. It costs nothing to set up at most custodians. If you're not in the right plan, this is a free fix with a hard deadline. Move number 2. Make sure your entity structure matches where you're going, not just where you are. A lot of growing businesses are still structured the way they were when they started. Maybe that's a sole proprietorship. Maybe an LLC taxes a sole prop. Maybe an S-Corp they elected without fully understanding the implications. The entity structure that made sense at $100,000 in revenue might not be right at $500,000. And it might be completely wrong if you're thinking about selling in the next 5 to 10 years. Key questions to be asking your CPA right now. Should I elect S-Corp status? At what income level does it start saving me more in payroll taxes than it might cost to administer? If I think I'll sell this business someday, should I be thinking about C-Corps and QSBS treatment now, before the business grows to a point where the election gets complicated? Do I have my real estate in a separate LLC from my operating businesses? These are questions your CPA should be helping you think through proactively. If they're not, that's worth noting. Move number 3. Stop treating your CPA as a tax preparer and start treating them as a tax strategist. Or hire someone that fills that role. Here's the difference. A tax preparer files your return correctly. A tax strategist calls you mid-year and says, based on where your income is heading, here's what we should do before December 31st. Most CPAs are set up for compliance. They're managing hundreds of clients through filing season. Proactive strategy isn't part of the standard service model at most firms. This isn't criticism, it's just a reality. And it means that as a growing business owner, you have to either find a CPA who does both or build a team where someone else is filling the strategy role. What I find in the industry is that most CPAs, attorneys, and advisors don't even communicate. Or if they do, it's very minimal. Your CPA does their thing, your financial advisor does theirs, and nobody's connecting the dots. The coordination gap costs money. The sooner you build a team that talks to each other, the better. Move number 4. Get basic estate planning in place before your net worth makes it complicated. I know, estate planning sounds like something for wealthy retirees. It's not. If you own a business and you don't have a will, your state's intestacy laws decide what happens to your ownership stake when you die. That might mean the courts get involved in your business succession, and that's not what you want. At a minimum, growing business owners should have a will that addresses what happens to your business interest, a basic business continuity provision in your operating agreement, who controls the business if you're incapacitated or die, a beneficiary review. Are your retirement accounts, life insurance, and other accounts going to the right people? You'd be surprised how many successful business owners operate without a formal operating agreement that clarifies who controls the business if the owner passes away. Without one, courts decide. And that outcome is rarely what the business owner would have chosen. The good news is, basic estate planning at this stage isn't complicated or expensive. The more you wait and the more your business grows, the more complex and costly it becomes. Move number 5, and this one is more strategic than tactical. Start asking whether your business is building equity or just generating income. Here's what I mean. Some businesses have enterprise value. If you walked away tomorrow, somebody would pay you real money for what you built. The client relationships, the systems, the brand, the recurring revenue. Other businesses, and there's no shame in this, are more like a well-paying job. If you left, the revenue would leave with you. There's not a lot for a buyer to purchase. Neither is inherently better, but you should know which one you have because it changes how you plan. If your business has enterprise value, you should be thinking about exit planning, protecting that value, building systems. Don't depend entirely on you, exploring what a sale might look like in 5 to 10 years. If it's primarily income generating, your focus should be on building personal wealth outside the business, because the business itself isn't going to fund your retirement the way a sellable asset would. I work with a family who kept reinvesting everything back into the business. Over 80% of their revenue came from a single client. As they aged and that client moved on, the relationship faded. They were left with equipment and missed opportunities to build personal wealth. The business generated great income, but didn't build lasting wealth because nobody asked that question early enough. Let's recap the 5 moves. 1. Get the right retirement plan and make sure you're maximizing it. 2. Make sure your entity structure matches where you're going, not just where you are. 3. Build a relationship with a tax strategist, not just a tax preparer. 4. Get basic estate planning in place before your net worth makes it complicated. And 5. Ask whether your business is building equity or just generating income, and plan accordingly. None of these are exotic. None of them require a massive financial overhaul, but all of them compound over time. Get them right early, and the next few years of growth set you up well. Ignore them, and you spend those years fixing preventative problems. Subscribe for more content on tax strategy, exit planning, and wealth coordination for business owners. This video is for educational purposes only. It's not personalized tax, legal, or financial advice. Every business and financial situation is unique. Work with qualified advisors before making decisions.